So remember that in our last class, we concluded the question on adjusted present value, isn't it? I'm sure by the time we ended the question, we learned a lot. So now we all have an idea of this technique called adjusted present value. I'm sure we all have an idea. But now let's talk about our exam. We need to be exam relevant. The challenges that you have in this exam is presenting your work. So what advice can we share? Well, the advice that I can share is I remember my days of management consulting. I remember my days of management consulting as a young consultant, financial management consultant. That's what I did. One thing that helped a lot on assignments was experience in terms of past assignments done. Whereas you go into an assignment, you go with a framework or a model to use. If you're doing a business plan, if you're doing evaluation, from past experience, you have frameworks or formats to use. So that used to help a lot. Yes, each assignment would be unique, but you find you already have a framework so that you work around the framework and then you panel beat the current framework based on the specific client requirement. I was thinking that approach also can help us in this exam, because towards the exam days, what I see people struggling with is really how to arrange the information on the worksheets. So my advice would be, for looking at investment appraisal, we have an APV question. By and large, any APV question will look the same. So what we would want you to do is have a framework so that whatever question we have, you even know that these are the portions that we have. And you arrange those portions such that even if you don't finish, the framework that you have put in place helps you. So for instance, on APV, what have we seen? We saw that when we're doing the best case NPV, when we're looking at the best case NPV, the cash flows that you work with are just the normal cash flows. The cash flows that we work with are just the normal cash flows. So we want an area for such cash flows. And in this particular question, that's what we have here. Instead of you doing your own sales revenues, this particular question gave us the operating cash flows. Operating cash flows. Meaning that most of the work has been done for us. Operating cash flows, and know what operating cash flows are. These are cash flows before interest and tax, but non-cash flows such as depreciation has been dealt with already, and the adjustment has been passed. So from this particular question, the cash flows are very straightforward. She predicts that it will generate 2 million operating cash flows before marketing costs in year 1 and 14.5 cash flows before marketing costs in year 2. With operating cash flows rising by the expected levels of inflation in year 3 and 4. Marketing costs are predicted to be 9 million in year 1 and 2 million in each of years 2 to 4. So already from here, in your framework, you already built up a table. So this enables you to build up a table. A table of what? A table of cash flows. So we've got a table of cash flows from here. The significant cash flow that you are expecting, other than that, is the tax, because the company pays taxes, and also the tax allowable depreciation. Then you've got your working capital. So as you read through, then you have an idea of the way the table will look like. So in terms of workings, then you know that I've got a bit of work to do on working capital. So this will require a working. So in your mind, you say, I'll need a working for this item. Equally, tell yourself, I will need a working for that item. What are you doing? You're trying to come up with a framework for or a table for your cash flows. After this, we know that the major item, which you must even learn before the exam, how to arrange your workings, is a discount rate. So each one of you should come up with your own way of arranging your cash flows to find a discount rate. And you know that this discount rate, we may need to use the CAPM. And if the CAPM comes in, there will be ungearing and regearing. The question is, how comfortable are you? How comfortable are you in using your worksheet to calculate this, to do the ungearing and regearing? So when I say that a consultant already has a recognized framework, this is where in real life, you even just cut and paste, where you have already developed your model or your approach of how I will do the ungearing. This you don't go and do in the exam. That's disaster. If you say me, I will go and practice in the exam first of all to ungear, that is disaster. Based on the number of questions you've done, like a consultant who has done so much particular assignment, you must go already just to test the approach. And similar vein, we did discuss that we may have to use the M&M theory. Now, when we did it in the first question, notice that this has got a bit of algebra. And if you have not already learned how to use the M&M theory to derive the appropriate discount rate, the exam is not a place to do that. It will just be disaster because you keep on canceling. So the takeaway is, what to take away home here really is, can we all come up with our own shortcuts and ways of ungearing? Okay. After that, we've got the issue of tax losses. On this exam now, we have seen the issue of tax losses a number of times. The relief that we have been used to for quite some time was the capital allowance. This was the relief. But now we are seeing increasing more and more questions talk about the loss relief. So you need then within the table, remember that in our approach, in our model, we've got a table. So Within that table, then, you need to ask yourself, how do I arrange within the table? How do I bring in losses? Again, it's not in the exam where we go and figure out why do I put losses. No, you go in the exam with a format already. And within your format, you have already provided in your mind where the losses will go. If they don't come, you just skip them. In your format, you have already agreed where you're going to put your capital allowances, less and deduct them. So this is what I meant by saying before the exam. Now, when you're doing the question, is the time to deal with these items. And after I've dealt with them here, you go to the platform. You go to your platform and in your platform, deal with these items. Having done so, we know that what is the next item? The next item where we need to pay attention is the side effects of financing. We need to know which items have come in a question. So it's a matter of just identifying the items that have come in a question. So like this particular question, we can see that they are mentioning of the issue costs. So there's the issue costs. We are paying interest. So there's the issue of the tax shield. There's also the government loan. So there's the issue of the subsidy. Such that if you're doing your summary somewhere, you can do a summary that in my APV, there's going to be my best case. NPV. Then I'll bring in these items. Again, you need to be very clear about the discount rate. The good news is that there's no computation for the discount rate that we're going to use at this stage. It's either use the company's cost of debt or the risk rate. So once you approach a question like this, then you know that I'm okay. Now remember that in the exam situation, we will not get everything right. But what will enable us get our marks is to ensure that we've got a well-formatted answer. A well-formatted answer. With that brief briefing of the question debrief, we can now look at this particular question. We can look at this particular question. So let's look at this particular question. Let's look at this particular question. And let us see what we can learn from this particular question. Okay. So what you have here is really a solution that I've done around which we want now to discuss. So we want to go now into a discussion for this solution that I have done. We have identified a number of items. So it's not an issue now. We have discussed the items. We have discussed a number of items. So it's not an issue. What are those items that we have discussed? Well, it's the components. It's the components. Number one, we need the cash flows here. So this is our table. This format, as you read through in your worksheets for the best case NPV, you start slotting in the information that has been given. The details given, you can start slotting them in. So if you remember, this is what we had in the debrief. That's what we had in our debrief. We showed that in terms of the cash flows, when you're looking at the table, you're much more concerned about the cash flows. So in terms of the cash flows, we didn't have so many in this particular question. So the cash flows that we have are all here. 2 and 14 were given. What of these others, where have they come from? I'm sure you can see what we've done here. I'm sure you can see we have also pasted or brought on board the inflation rates. These are the inflation. In year 3, 5%, in year 4, 4%. And this is what we have done here. We take this figure, increase by 5%, then increase by 4%. Marketing costs were all given. Marketing costs were all given. Good. Now let's talk about the format. One of the things that can help you a lot, or the format that you can carry to your exam, is the one we have indicated here, where for taxation, we have a working outside this. Working capital, a working outside this. It's much easier. It's much easier where you've got a separate working. So if you got a question, well, you put your cash flows, the cash flow before tax and taxation, put it outside, working capital, asset, and then the 9%. So let's discuss the taxation. Let's discuss the taxation. Let's discuss the taxation. So the tax, there is up the allowances 25% reducing balance, 25% reducing balance. In the final year, there's 13.5. So we take the 30,000 or 30.6 million, or if you throw away 3 zeros, work with 8,600. And there's no issues, it's just 25%, isn't it? I hope you have your calculators there too. So you apply 25% on this figure. So that's the capital allowance for year 1, or written the tax allowed depreciation. So the written down value then is not less than. So that is written down value. So in year 2, again, you apply percentage, you get that. You subtract, then again you knock off that, you arrive at that. So this is in year 4. So in year 4, at the beginning of year 4, that's your written down value. Then we don't calculate, we don't apply 25% on this, no. We try to ascertain whether there was a balancing allowance, looking at all the allowances that you have received so far, or indeed there was a balancing charge. Is there a balancing allowance or a balancing charge? So let's go. So you've got a disposal value of 13.5. So we have an asset whose written down value after knocking off these allowances here that you have received. What has not been claimed is 12,909, but you say it for 13.5. So the story changes. You have a balancing charge. Now, this was after a long time. The examiner for many years, in fact, I think it's the only question where you find a balancing charge. Most of the time, it's a balancing allowance where the disposal proceed is less than. So this time around, it wasn't a balancing allowance, it was a balancing charge of 591. So after you've calculated this, how do you come up with the taxable cash flow? Well, now this is the format that we want you to carry. You take your cash flows before tax. Where have these come from? There's no issue. This is what you have here. It's these. Those are the ones that you have. So you knock off the tax allowed depreciation was the charge you added so that you can tax it. So the taxable cash flows are here. Then you bring in the loss relief. The loss relief. So in year one, we made the loss. This loss is available in year two. So taxable cash flows, here there's a minus, so we won't tax anything. There was a minus. So in this year, after bringing the loss, we still have the loss of 788, which we carry forward. Now here we've got the taxable cash flows and taxable cash flows. So what lesson do we want to pick from here? Please borrow this format. Borrow this format. Borrow this format and use it. Okay.
Mr. Perry.
Yes, please.
I noted that in the question, whether I don't know whether I missed it, where the tax is it payable in the year? Is it payable after a year, or is paid in the year in which it is incurred?
The tax itself.
Mm-hmm.
So let's go. People company pays tax at annual rate of 30%. Tax is payable with a year's time delay. Any tax losses on the investment can be assumed to be carried forward or written off against future profits from the investments. So this is your working here. That's a good point there. I hope it's clear on your screen as well. Is it clear on your screen as well? Okay.
Yes, I'm seeing it.
Yeah, so you've got your tax. So first of all, you have identified the tax payables. So these are the tax figures. Okay. So then you have worked out the tax. Let's now come here. So you bring it now here. So have you seen what we have done here? The tax for year 3 is paid when? The tax for year 3 is paid when? In year 4, the 310. Have you seen that? And that. Is that okay? This one who you got out a very good point. Table in, and this one, table in, year 5. Okay. The only thing that may delay us is probably if we are figuring out how to arrange the figures. That takes a bit of time. But once you arrange figures in one question, consistently use the same approach. What of working capital? Working capital is quite interesting here. Working capital is quite interesting here. What do we mean? Let's revisit working capital together. Let's revisit working capital together. The new facilities will also require an immediate initial investment in working capital of 3 million. So 3 million immediately. Working capital requirements will increase by rate of inflation for the next 3 years. Now you see, the examiner was quite friendly here. The examiner was quite friendly. In what sense? He has told you, he has given you a hint. Then this figure will increase, right? Yeah. Over the years, if you ask me what have I noticed, what I've noticed is that the AFM examiner is really making the work easy for the students. There are certain things that we are seeing more and more coming to the paper to direct the students, like this one. In some papers, they won't tell you. What they expect is that, look, this person is a professional. This one is a senior finance executive. You must know that there's no way working capital will remain the same if prices are moving up by these percentages. So it was quite fair that the examiner gave you a lead, but otherwise, you are supposed to realize that when there's inflation going on, how do we expect the working capital to remain at the same level of 3 million throughout the project? No, it can't work because prices are going up, isn't it? So you would need to inject more and more. But this one, they told you that it will increase. Eh? That was quite a fair way of doing business. So this is increasing 8% to here, 6% to there, 5% to there, and 4% to there. Are we happy with that? Are we happy with that? So I expect you to take your calculators. This should move to there by multiplying by 1.08. Then here, 1.06. Then there, yes, please, there's a hand which is now.
Yes, good evening, Mr. Piri. Just a bit of some clarification on the working capital. So
Yes.
if in the scenario, there's no mention about an increment in working capital, but there's inflation in other elements, one should take into that account to inflate the working capital.
Okay, so look at where I'm highlighting. Are you seeing where I'm highlighting?
Yes, sir.
Are you seeing what you have said? This word here?
Yes, yes, sir.
They say the working capital will increase by the rate of inflation for the next 3 years. And it's on this basis that you're inflating like that. Now, if the question did not tell you, and they say there's working capital, there's inflation like this, it will be prudent for you to go ahead and increase working capital. You don't have to wait for that statement now, because as a senior finance executive, you know that when you have been given inflation, the prices are going up, isn't it? Meaning that we cannot run with the same amount of 3 million throughout. No, this figure will certainly do what? This figure will increase. Okay. So in some questions, they're as clear as they are here. In other questions, they not be as clear. But once there's inflation, what you know is that inflation should also impact your working capital. Working capital cannot increase, cannot be at the same level. Why? Well, because the inflation figures are going up. Now, what do you load in your cash flows? You know what you load? A mistake which the examiner would not want to see at all in your work is somebody to load in these. If you loaded in these, certainly the examiner will be very upset with you. These are not the cash flows. The cash flows that you're going to load into your are these: the initial amount and the increase. And then at the end of the day, that plus that plus that plus that gives us that. So these are cash outflows. That's an outflow. That's an outflow. That's an outflow. That's an outflow. And this becomes an inflow. So this is what we expect, surely. Surely, that all of us will be able to treat this correctly. So here we are. So these are the figures here. And the asset cost is 36 and 13.5. Beyond this, what is it that we need now? This is now what the marker will be looking for. Let's just break this